I have a regret in my life. Back in 2008, after the financial crisis, I didn't buy US stocks. At that time, I was too young. I didn't understand the finance. But this time, I won't miss the chance again. Hello everyone. Today I will talk about the issue of France potentially triggering the next European debt crisis. This topic is also a supplement to my earlier discussion on gold investment. I started investing in gold in 2023, and the reason why I only recently analyzed the logic behind gold's rise is that I only started making this video channel recently. It may look like I am chasing the trend, but this time, regarding the new round of the European debt crisis and the related investment opportunities, I am making the analysis in advance, before the crisis actually breaks out. Now, let us begin today's discussion. People may still remember the European debt crisis that broke out more than 10 years ago. Today, that debt time bomb is once again being ignited. The French government is sinking into turmoil over its budget plan. On August 25, Prime Minister Bayrou stated that, in order to get out of the difficulties faced by the government, he asked the National Assembly to hold a vote of confidence on September 8 to seek support from all political parties. At the same time, the capital market is experiencing a storm. From August 25 to 26, the French stock market fell for 2 consecutive days. On August 27, the yield on France's 10-year government bond once rose by 3 basis points to 3.53%, while the spread with German bonds of the same maturity widened to 80 basis points. Just 2 weeks earlier, the spread was only 65 basis points. The simultaneous fall of stocks and bonds shows that investors are increasingly worried about France's political outlook. This is triggering an unprecedented crisis. So, what exactly is happening in France? The turmoil began on July 15, when former Prime Minister Bayrou announced the 2026 budget plan and made a disastrous assessment of France's public finances. Data showed that in 2024, France's fiscal deficit reached 5.8% of GDP, much higher than the Eurozone average of 3.1%, making it the worst among Eurozone countries. Worse than Greece, Spain, and Italy. Moody's previously predicted that in 2025, France's deficit would deteriorate further to 6.3% of GDP, which is double the European Union's red line of 3%. This means that France is rapidly falling from being a pillar of Europe to the weakest link in the Eurozone economy. In order to rescue France, Bayrou made reducing the deficit the top priority of his government from the very beginning. Based on this thinking, the 2026 budget proposed to cut 43.8 billion euros in fiscal spending and lower the deficit ratio to 4.6% of GDP. As part of tightening measures, Bayrou planned to increase taxes, limit pensions and social welfare, and even cancel 2 public holidays. The National Assembly originally planned to review the budget on October 14. Everyone knew that France's debt situation was unsustainable, so although the medicine prescribed by Bayrou was bitter, it was intended to save the country. However, the announcement of this plan immediately caused a huge political storm inside France. As before, the budget plan was strongly criticized by the opposition parties. Under this pressure, Bayrou asked the National Assembly to hold a vote of confidence, hoping that lawmakers would first recognize the seriousness of the national fiscal situation and give his government support. But from the far-right National Rally to the far-left France Unbold, as well as the Green Party and the French Communist Party, almost all parties promised to vote against him. The Prime Minister's office had hoped to reach a compromise with the center-left Socialist Party, but the Socialist Party's Secretary Faury had already declared that the Socialists would vote against Bayrou's government. The Green Party's National Secretary Tony Lee even said bluntly that this move was equivalent to resignation, a form of self-dissolution. The opposition of the Socialists was fatal, because Beilou's centrist alliance only controlled 210 seats out of 577 in parliament. Considering that the far right, far left, the Greens, the Communists, and the Socialists all announced they would vote against him, this led to the collapse of Beilou's government. But was the budget plan submitted by Beilou's government really so bad? Not necessarily. Whether it is raising taxes or cutting welfare, these are normal measures that any country adopts in times of economic difficulty. The opponents could not have been unaware of this. The real purpose of their attack on the 2026 budget was to bring down Beilou's government and replace it with their own people. Each party had its own agenda, but none considered long-term interests of France. The price will be the future of the country. The reality is that any prime minister who dares to propose cutting the budget will face resistance in parliament. At best, the plan will fail. At worst, the prime minister will step down and the government will collapse. This is not only the case in France, but also in many European countries, where welfare spending is too high and current economic growth cannot sustain it. Welfare spending must be reduced. But under democratic politics, the party that dares to do so will quickly be abandoned by voters. In France, with its history shaped by the revolution, people prefer struggle over compromise. This has made France lose the ability to correct itself and miss the opportunity to save itself. The problem now is that no matter who takes power, they will not be able to save this country. France is already critically ill. France's problems are highly represented within Europe. Internally, the large influx of immigrants, combined with heavy tax burdens, has led to a massive outflow of elites in recent years, which in turn has driven capital flight. This has greatly reduced France's attractiveness as an investment destination. The Russia-Ukraine war that broke out in 2022 was like a heavy hammer smashing global capital's confidence in Europe, leaving the already pressured French economy fully exposed to a storm of uncertainty. According to data disclosed by French foreign trade officials, in 2024 alone, domestic investment projects dropped by about 1,700, a decline of 7%. This was essentially capital voting with its feet, and capital flight is never an isolated event. Without funding support, expansion becomes limited. With energy prices remaining high, many companies simply went bankrupt. In 2024, the number of bankruptcies in France exceeded 66,000, the highest level in 14 years. Large-scale corporate bankruptcies inevitably triggered a wave of unemployment, and the rising unemployment further widened the wealth gap, providing fertile ground for the rise of right-wing forces. This is why the national rally led by Marine Le Pen has been gaining momentum in France in recent years. The root cause lies here. The rise of the right wing inevitably fuels social division and deepens polarization. In the end, such instability further drives global capital and elites away from France. It is not an exaggeration to say that France is now caught in a vicious cycle of capital flight, rising unemployment, social fragmentation, and declining attractiveness. This is also the dilemma faced by many European countries. This year, the trade war launched by Donald Trump dragged the French economy into an even deeper quagmire. Do not be misled by the fact that the United States and the European Union have already reached a tariff agreement, reducing most tariffs on EU exports to the US from 30% to 15%. In reality, many of the details are unfavorable to France, especially in its broad agricultural sector. For example, France sells about 350 million euros worth of dairy products to the United States every year. Yet in the agreement between the US and the EU, French advantage exports such as wine and cheese were excluded from the exemption list, meaning they continue to face high tariffs. This was by no means accidental. It is well known that the American dairy and wine industries have long sought to squeeze French products out of the market. This discriminatory treatment in tariffs will directly weaken the price competitiveness of France's leading agricultural exports in the U.S. market. Moreover, the United States also demanded that the EU simplify sanitary certification procedures for meat and dairy products. On the surface, this simplification seems aimed at lowering trade process costs, but given the characteristics of American agriculture, the real intention behind it is obvious. U.S. agricultural products are known for large-scale, low-cost production. However, because the EU maintains stricter standards for agricultural imports, food safety, and environmental protection, many American products have so far been blocked from entering the European market. Once the EU relaxes sanitary certification in accordance with US demands, it will essentially open the door for cheap American agricultural products to flood into Europe, and whose interests will be sacrificed, primarily France's. That is why, after the agreement was reached, French Prime Minister Bayrou wrote on social media that this was a dark day, when a union of free peoples should have come together to confirm their values and defend their interests. They were instead forced to submit. From the data, France's trade deficit in the second quarter reached 22.9 billion euros, expanding by about 2.8 billion euros compared to the first quarter. The continued weakness in trade performance highlights the destructive impact of U.S. tariff increases on the French economy. Under the combined pressure of a turbulent domestic economic environment and external demand weakened by tariff shocks, Al Jazeera forecasts that France's growth rate in 2025 would not exceed 0.6%, compared to 1.1% in 2024. This is one of the lowest growth rates among major European economies, and also France's weakest since the 2020 pandemic. Yet government spending needs remain enormous. As is well known, France is a typical high welfare state. Its social security network not only has wide coverage, but is also renowned for its thoroughness. From housing subsidies, medical insurance, childcare subsidies, to unemployment benefits, the system contains nearly 400 welfare items, but behind this sense of security lies huge fiscal spending. Data show that in 2022, France's social welfare expenditure accounted for 31.6% of GDP, not only far above the OECD average, but also among the highest in major European economies. Looking at it now, being immersed in a high welfare system for so long is not entirely a good thing. Because people have grown used to such a comprehensive safety net, many French citizens have become extremely sensitive to any changes in welfare levels, even forming the psychological expectation that welfare can only rise, never fall. Once people have this mindset, it becomes very difficult for the government to adjust the welfare downward. Citizens will feel that their bottom line has been crossed, sparking strong resistance. In recent years, whenever the French government attempted even minor adjustments to the welfare system, people immediately took to the streets. This reflects the problem. In terms of defense, France has long relied on NATO. But Donald Trump's ruthless abandonment of Ukraine made France realize the enormous risks of relying on U.S. security commitments. Americans cannot be fully trusted. To avoid this passive situation and ensure its own strategic autonomy, France has had to accelerate the upgrading of its defense spending, which also requires huge funds. On July 13, President Macron announced an additional 3.5 billion euros in military spending for 2026 and a further 3 billion euros for 2027. By then, France's total defense budget will reach 64 billion euros, doubling from 32 billion euros in 2017. Where does this money come from? Mainly from borrowing. The last time France achieved a balanced budget was back in 1975. In the decade since, the country has relied on living beyond its means to maintain the appearance of prosperity. But this has also caused the debt snowball to grow ever larger. By mid-2025, France's total debt, both public and private combined, had already expanded to about 7.65 trillion euros, more than twice its GDP. That is equivalent to every French citizen carrying a debt burden of over 110,000 euros. Even worse, the fiscal drain from paying interest has become unbearable. According to Barclays, France's interest costs this year will reach around 62 billion euros, roughly equal to the country's entire annual spending on defense and education. This means a massive share of fiscal resources is being consumed by debt interest, and if no action is taken, by 2029, these costs will climb to about 100 billion euros. This is why Prime Minister Bayrou was willing to risk being forced out of office in order to push forward the 2026 budget plan. The debt pressure is simply too overwhelming. Without reform, France cannot hold on. Yet while France struggles with the contradiction of rising military spending and surging debt, an even more worrying signal has emerged. Germany, long known for fiscal discipline and once the ballast of the European economy, has now also stepped onto the path of heavy borrowing. This casts an additional shadow over Europe's debt predicament. As a classic export-oriented economy, Germany relies heavily on external markets. Since 2024, however, the dual shocks of weakening global demand and international turbulence have pushed Germany into high inflation, sluggish growth, and rapidly climbing bond yields. Under such pressure, German Chancellor Merz recently admitted that the country's welfare system had become fiscally unsustainable. In March this year, Germany was forced to break its long-standing fiscal discipline by loosening the so-called debt brake mechanism, once regarded as a safeguard of fiscal stability. On the surface, this policy seemed to inject new vitality into Germany's economy, but hidden risks lie beneath. First, relaxing the borrowing cap directly raises the government's debt level. A once relatively healthy fiscal position will be undermined. In the future, not only will Germany face repayment pressure on the principal, but in a high-interest environment, interest costs may also keep rising, further squeezing fiscal room. More critically, when even Europe's most stable economy has to live on debt, it means there are few, if any, countries left capable of withstanding a potential debt crisis. This will further erode market confidence in European sovereign debt. France's debt is already precarious, and Germany now clearly shows signs of following in its footsteps. For Europe, which already has significant debt risks, this is like adding frost to snow. The most dangerous part is that if France's crisis truly erupts, the impact will be far beyond the scale of the previous Eurozone debt crisis. After all, France is one of the political and economic leaders of Europe. Many still remember vividly the devastating consequences of the 2009 Eurozone debt crisis. And who was the trigger back then? A country like Greece, whose economic weight in the Eurozone was insignificant compared to France or Germany. The crisis later spread to Ireland, Italy, Spain, and Portugal, all of whose economies were far weaker than Germany and France. At the time, Germany and France were the pillars of both the Eurozone and the EU. They led the bloc out of crisis and contributed the most financially. Officially, bailout funds came from the European Central Bank, the EU, and the International Monetary Fund. But behind the scenes, the bulk of the burden was shouldered by Germany and France. For example, in the first round of aid to Greece, a 110 billion euro loan from the IMF and Eurozone Germany contributed 22.4 billion euros, and France contributed 16.8 billion euros. Together, they accounted for 36% of the total. In the 2010 European Financial Stability Facility, with a total subscribed capital of 700 billion euros, Germany provided the largest share at 190 billion euros, followed by France with 142.7 billion euros. Together, the two countries accounted for nearly half. In other bailout packages, the pattern was much the same. Germany and France both contributed heavily in money and effort. Of course, many remember what happened afterward. Once those emergency funds reached the hands of these countries, getting them to repay both principal and interest proved anything but easy. At the height of their crisis, these countries demanded more rather than showing gratitude. In the end, it was not until 2018, 8 years later, that Greece finally exited its long bailout program. As for when the debts incurred back then will be fully repaid, the Greeks showed little concern. That massive sum of money sowed the first seeds of today's debt troubles in Germany and France. Two landmark events occurred during that period. First, in June 2010, the French government announced a pension reform plan, raising the retirement age gradually from 60 to 62 to ease fiscal pressure. This triggered fierce protests at home. Second, also in June 2010, the German government launched a 4-year fiscal austerity plan, aiming to cut 80 billion euros through revenue increases and spending reductions. Clearly, the first round of the Eurozone debt crisis had already forced both European leaders to the brink. This also means that if France triggers the next crisis, self-rescue will be nearly impossible. Germany, struggling with its own problems, will not be able to help. As for the other member states, there is little to expect. They all relied on Germany and France's support to maintain their high welfare models in the past. How could they possibly bail anyone out now? Therefore, if a new round of Eurozone debt crisis breaks out, it will be on a completely different scale from before, and will be nearly impossible to resolve. The Eurozone could collapse, and the Euro itself may come to an end. The problem is, why did Germany and France embark on this path of slow suicide? The root cause lies in the contradictions of the Eurozone mechanism itself. A unified currency and monetary policy, but no unified fiscal policy. Once any member state falls into crisis, the entire Eurozone and even the EU gets dragged down. This leaves only two options. The first is to let the crisis run its course. When Greece's crisis broke out last time, Germany initially chose this route, coldly standing by without offering help. But as the criticism of Germany's lack of morality grew louder, Berlin's leadership position in Europe became shaky. Merkel had no choice in the end but to take the second path, the slow suicide we just mentioned. Put simply, the uneven structure of Eurozone members doomed its leaders to eventually be dragged down. Back then, the UK refused to join the Eurozone precisely because it saw through this fundamental flaw. Later, it even exited the EU altogether to avoid being dragged down. Now, with France teetering on the brink of crisis, it may not necessarily be bad news for other countries. Just like during the last European debt crisis, when Greece was on the verge of collapse and scrambling for money, the mess it created was far too big to be fixed by a few loans. And let's not forget, these funds were not free. Debt must be repaid. At that time, China saw an opportunity. It stepped in multiple times to support Greece because of Greece's highly strategic geographical location. Sitting at the crossroads of Europe, Asia, and Africa, controlling the passage from the Black Sea to the Mediterranean and Atlantic, connected to the Balkans and close to the Middle East, Greece has always been a prize in great power competition. It was precisely because of this strategic geography that Greece, despite lagging far behind Western Europe in economic development, joined the EU earlier than Spain or Portugal, and entered the Eurozone in 2001, even though it did not fully meet the criteria. During its debt crisis, Greece signed a large number of agreements with China. Step by step, China's COSCO shipping group took control of the port of Piraeus, now holding the majority stake. Effectively, Chinese companies call the shots there, and Piraeus has become China's most important logistics hub in the Mediterranean. But coming back to the present, if France really falls into crisis this time, China won't be able to step in, even if it wanted to seize some opportunities. After years of economic slowdown, China itself is now deeply mired in debt, to the point where even civil servant salaries can't be paid on time. As for the United States, Trump has long been eyeing this situation. He's been squeezing Europe repeatedly, whether in trade agreements or on Ukraine. He takes every chance to extract concessions. If France runs into serious trouble, Trump will be delighted. He'll see it as the perfect opportunity to strike when Europe is weak. Macron is already deeply worried about this. He's been trying to pull Germany onto the same line with France. At the Franco-German Ministerial Council on August 29, Macron raised the issue of the digital tax, accusing Trump of coercion. That word was no accident. It comes directly from the EU's anti-coercion instrument that came into effect in 2023. According to this regulation, if a third country harms the EU or its member states' interests, the EU will act as one, imposing countermeasures in solidarity. Every word Macron used was carefully chosen. By invoking this regulation, his goal was to urge the EU, especially Germany, Europe's other leader, to stand with France on the same front. And what about Ukraine? It will find itself in an even more passive position. Last time Zelensky visited the US, if European leaders hadn't stood beside him, Trump might have sold out Ukraine completely. Macron's words back then were unusually tough. But if France plunges into a debt crisis and has to rely on U.S. assistance just to survive, would Macron still dare to speak so strongly? If Germany and France, the only European countries bold enough to talk tough to Trump, can no longer hold their ground, then Ukraine will truly be left without any reliable support. The risks in France will also have a huge impact on global trends. If a new European debt crisis breaks out, the euro will collapse and the US dollar will surge in the short term. This will create an unusual situation where the dollar rises, even though the Federal Reserve is cutting interest rates. Please note that I emphasize this is conditional on a debt crisis breaking out in Europe. That is the key premise. In fact, the euro has already been very weak in recent years. Back in 2022, the euro fell below $1 for a time. Later, it recovered, but it has hovered around the 1-to-1 level several times. What does this mean? The birth of the euro was an attempt at integration within Europe. By unifying currencies across countries, hidden tariffs and trade barriers were removed, and the destinies of euro area members were tied together. The goal had two parts. First, to increase the stability of the Eurozone economy and attract global capital. Second, to gradually reduce dependence on the US dollar and eventually challenge it. But the euro has been weak and stuck near 1-to-1. That shows the euro has been badly squeezed by the dollar. Capital does not want to stay in Europe. If France triggers a crisis, the euro could fall much further. Even maintaining 1-to-1 may no longer be possible. Forget about challenging the dollar. The outcome would be worse than the last debt crisis. This round of Fed rate cuts has come at the right moment. The negative effect of cutting rates on the dollar is at its lowest. On September 17, the Fed announced a rate cut. The dollar index did not fall as it used to in the past. If a new Eurozone debt crisis breaks out, European capital will flee in larger amounts to the United States. That will give even stronger support to the dollar and push it up against the trend. For capital markets, if a new crisis breaks out, European stock markets will definitely crash. That will also trigger temporary declines in US and many emerging market equities. But after the shock is digested, markets will diverge. US stocks are likely to return to an upward trend. Fed rate cuts will also give them a boost. In this sense, the Fed chose a very good time to cut rates. As for emerging markets, they will have to rely on their own strength. Fed easing usually means capital flows back to the US. That could create a siphon effect and hurt emerging markets. For example, in China, foreign investors have recently been pulling out. Gold will gain new support, whether it is a worsening French crisis or Fed rate cuts. Both favor gold. Gold has already started to rise. By September 3rd, international gold prices had risen for 7 straight trading days. Gold futures in New York broke through $3,600 per ounce and reached a record high of about $3,640.1 per ounce. Silver has also surged. Spot silver broke above $40 per ounce for the first time since 2011, with gains of more than 40% this year. In short, if this new crisis breaks out, the consequences will be much greater than the last time. In the previous crisis, Germany and France acted as the strong backstops. This time, the strong countries are collapsing first, and that will destroy people's hope. A falling France will have deep consequences for global capital markets. With the new debt crisis, the world order could be reshaped at any moment. For us, the key is to follow the trend, avoid risks while seizing opportunities. Of course, this does not mean the crisis will explode immediately. France is still a major power and may hold on for a while. I am sharing this analysis in advance to remind everyone to pay attention. Once the crisis nears breaking point, it will be time to sell vulnerable stocks and wait for the right moment to buy again. That is all for today. Thank you for watching, and I will see you in the next episode.